Swayam Prabha. Digital India. Educated India.
What we did in the last class is to talk about traditional money, how it developed. It was initially metallic coins made out of precious metals, then they shifted to non-precious metals, then some form of paper currency came. So, banking institutions were coming into existence. Then what happened was proper paper currency was invented, which we have now, and I read out from Indian currency. What are the things written on it? And therefore, this became the most common form of currency in most countries, and we have a fractional currency system in most countries. So, coins are a small percentage and paper currency is the dominant one, but that was not making everybody happy when it came to a means of transaction. So, what happened was the checking system developed, accounts in banks with checking facility. That really helped people, because you can write a check, make a payment, or you write a check, withdraw your money. That helped people, and that was a significant development after paper currency. Now, there is also something in the literature which they call near money, and near money is essentially money which is not as liquid as money that we have just talked about, which is currency, which we have in our pocket, in our savings accounts, in our locker. That money is the money that is not as liquid as the money we have, and near money, I gave you examples of fixed deposit accounts, money, mutual funds, etc., which are near money, in the sense it is not exactly as liquid as cash. That is why the word near money is there. This more or less sums up the traditional forms of money. Now, in modern age, when you come to modern money, what we see is various kinds of cards through which you can make a payment, and various kinds of, because of the internet last 20 years or so, we have various kinds of e-money, electronic money. Now, you know, you are more aware of these kinds of modern money than I am. For instance, when I was your age, I saw cards, and I remember in one of the prime business locations or the office areas of Calcutta, there used to be this big office. I used to see that, and some person known to me used to work there, which was the American Express office, where they used to probably provide facilities, card facilities to select customers, Visa, etc. American Express card, Visa. This card, we used to call them charge card, where digital revolution did not take place, but these cards can be used to make payments. And then when I went abroad for higher studies, I found no electronic money still. I found there are other companies also providing such facilities like MasterCard, etc. So, the card system, the charge card probably is one of the oldest form of other kinds of money, which is modern money, where you do not carry cash, you make payment with the help of a card, then the company who sells you goods will carry those transaction amounts to your bank, and your bank will remit that amount to that seller from your account. All right? Okay. So, naturally cards were provided to people who have sufficient amount of money in their savings accounts. Fixed deposit account won't help. The accounts which will help to make the payments are the savings accounts, which are called demand deposit accounts. In monetary economics or banking literature, they are known as demand deposit accounts, not time deposit accounts. Time deposit accounts are fixed accounts. Demand deposit accounts are savings accounts, for instance. All right. So, cards were there. These cards, these charge cards also had another name called credit cards. These credit cards exist. But then these credit cards, in addition to that, when I was a student in the early 1980s, the bank told me you can now also have another card, which is not a credit card. I never had a credit card as a student, of course not. They said you can have an ATM card, or they used to call their instant teller machines ITM cards. It is also known in India as ATM cards, automatic teller machines. What happened with these cards is, if you do not have cash, you go to an ATM machine and withdraw money. So, you are not making a payment with the help of the card, but you can use the card to withdraw cash from your account, which otherwise what we do usually is go to the bank and withdraw it. So, beyond banking hours you can use the ATM card, and even during banking hours you can use the ATM cards. So, the ATM cards came into existence. Then a number of other cards that have developed, which I do not use them, I still do not have them. One is called a debit card, which is probably slightly different, because in a debit card you have electronically, essentially, these cards enable consumers to purchase goods by electronically transferring funds from the bank accounts to a company's account. So, debit cards are making use of e-money. So, if you have a debit card, electronically you log into your account and then transfer money from your account to. So, the debit card and the e-money are simultaneously being used. But a more sophisticated form of debit card that has developed in Europe first, in England and some European countries, and now it has come here, are known as the smart cards, the store value cards, where electronically this card carries some cash in digital format. So, when you go to a bank, when you go and make a payment with it, the seller of the good immediately knows that there is some cash in it, and he can just take that cash out, like the ones we use smart cards in, for instance, even children's hobby centers in say malls, etc., like the Z Square Mall. They gave us a smart card with digitally stored cash, whatever cash I gave him, and then as soon as my daughter or son plays something, some amount gets deducted and automatically electronically recorded in it. So, these are digital developments and cards becoming more sophisticated started happening simultaneously, they did not happen separately. So, these are the modern forms of money that, which is horrendous, because now how do you keep track of value of transaction? Earlier it used to be only through the bank accounts, now with electronic payments, etc. Anyway, it is a different story. Now, smart cards can also be, these stored valued cards can also be used as ATM cards, they are multi-purpose cards. They are used as charge cards, they are used as ATM cards, they are used for various purposes. You can also use that for an ATM machine to actually withdraw cash. You can use that to make a payment like our credit card system, Visa and MasterCard, the old system, they can all there. Okay. And then of course, you have e-accounts, electronic transfers in simple forms without a card. You need a login ID to a bank account. You can make the electronic purchases, and as soon as the money is deposited in the seller's account, they deliver the goods, provided you trust the sellers. Once you transfer the money, it gets delivered. It has to be a respectable seller whom you can trust. Problem here is the buyer does not know the seller. With the electronic system, you are buying a good in US market sitting in India. The buyer does not know the seller, or even within a country, the buyer may not know the seller. You you are not visiting the shop, you are doing an online shopping. So, there has to be a degree of trust with this kind of a money, a different kind. Earlier it was, is this coin or currency acceptable to everybody? That was the issue. So, they had the emperor's portrait or the queen's portrait on the coin. Then they became the paper currencies, which is backed by the Central Monetary Authority, with everything written. I read out the paper currency, how much it is written, you should read how much material is just typed, printed on it. We use notes every day, but we do not read what is written on the notes. So much is written, so much, quite a few lines of text there. So, it is a question of trust also, confidence that emerges, whether if you make a payment, whether you will get the thing back or not. An electronic checking system has also developed, just not account to account transfer, electronic checking systems. So, modern money has taken the form of, because of internet and these digital revolution, these card systems. Even the IIT Kanpur ID card is a smart card. It has all sorts of information recorded in it. My blood group, my name, my house number, all sorts of things are recorded. One day we may have these lecture rooms with these locking system, where you have to use these ID cards to get in. You cannot get in probably without it. Like the high security zones, we have this kind of a digital cards used. Only a few, or say fingerprint, another form of recognition they use, fingerprint, then eye is also very distinct, and these cards is a high security zones, they use that usually, government offices, etc. maybe. Okay. Now, this part is a short part to electronic money, which you know more because you use electronic money. I still do not use electronic money, and so I have very little experience with it, except with automatic teller machine cards I know. Now, automatic teller machine cards were also used and still can be used to make payments. They carry these counters, carry envelopes. When you make a payment, you can get the receipt, put it in the envelope, seal it, and then there is a post box like a box where you drop it. Automatic teller machines abroad, at least I have found many years back, 30 years back, you cannot, you can withdraw cash, but also you can use those machines to make payments with the help of checks, checking systems, and envelopes. There used to be envelopes in those machines. So, envelope will come out, you put the receipt, or you have a checkbook, you write a check, put it in there and put it right there. Bank has a responsibility to make that payment to the, say, the electricity supplier or the telephone bill payment or whatever, you are making a payment, all right. So, they have many facilities developed there many years back. Now, I come to the debt instruments, which is very important. Before I come to the debt instruments, these are various kinds of systems, institutional systems that exist in a country. And before I talk about, this is an introductory part I am doing. I am talking about money, how it is used and how commonly we have seen money in the country. Now, before I do that, the debt instruments, because there is a very important concept that is coming up, which is different from your macroeconomics, much wider. You probably know, or you may be wondering, sir, if in a wealth basket you have all sorts of items, one is money and bundle of items which are non-money, like shares, bonds, jewelry, property, even gold bars, all can have a price. And suppose you are algebraically formulating an economic model where you write the quantity and the price. Now, the question is, what happens with money? Does money have a price? Often people ask this question, because there are n goods, suppose you are modeling, okay, for the financial sector. Now, you have taken all items which has a price in the market. Shares have a price in the market, bonds have a price in the market, property has a price in the market. It may be different price for different property locations, but there is a price. What happens with the price of money? Well, the price of money is there, what economists say, and it is measured indirectly. It is not a direct price. The price of money is the interest rate. Why is it so? Because the price is measured here in terms of the opportunity cost of holding money. When you buy a bottle of Pepsi, you are holding it, you buy it, you pay a price for it, for keeping it with you. For holding some amount of cash, you pay a price, and that price is the opportunity cost of holding money, because if you do not hold the money with you, you will put the money in an account, bank account say, where you would earn an interest rate. So, that becomes a return interest rate, all right. So, you do not spend anything, you are earning something. But if you hold cash as you have in your pocket and you do not have that cash in the bank, you are paying a price. What is the price you are paying? You are not earning the interest income. So, price of money is indirectly measured in terms of opportunity cost of holding money, which is interest rate. Very wonderful concept. So, now economists are very happy. वो जो basket of goods है wealth पे, वो money का भी एक price मिल गया concept, which is not a direct price you pay, but an indirectly you pay because you are not keeping the money in the bank and not earning the interest. So, by keeping the money with yourself, you are losing that interest. So, that is the price you are paying. Okay? All right, everybody? Okay. Now, problem with money interest rate is, this is one interest rate I have said, but in a macroeconomic context, in an economy, there are so many interest rates. You just visit the bank and look at behind the bank cash counters, there is a board. It talks about various fixed deposit interest rates, 2-year fixed deposit pay, ye interest rate, 3-year fixed deposit, this interest rate, 5-year fixed deposit, this interest rate, savings account, this interest rate. Abroad, if you go, there are 4 types of savings accounts, 4 types of interest rates. We have one usually here, all right. Then you go to the bond market, there is an interest rate, because the return on bond is interest. Then you go to the secondary markets of bonds, there is another interest rate called the yield to maturity. So, you wonder, sir, so many interest rates are coming. So, what happens in the macro ISLM model, etc., where you have LM function or IS function, function of interest rate and output, you are thinking nice, one interest rate is there. But when you do empirical work in macroeconomics, you start wondering which interest rate to consider. Then when I will teach you money market, there are more interest rates, you will see. There is a call money interest rate, call rate, there is a treasury bill interest rate, yield rate, there is a repo rate, there is a reverse repo rate, so many kinds of interest rates are there. Now, what I would do, I will gradually take up these various kinds of interest rates, at least you know. Now, when you do research or any other work, you can think about which is the interest rate most appropriate for your study. You can think about that then. For the time being, my duty is to tell you about various kinds of interest rates that exist. So, I start from debt instruments commonly used or commonly that exist in a country where interest is charged. Why is interest rate charged? First of all, what is the logic, a basis for interest rates being charged? The interest rate is charged because as a bank, if I give you some loan, I charge an interest rate. Reason is that money is not with me, so I cannot use it. I have given it to you. Now, you would return the money say 1 year later, 1 year loan. So, I have to wait 1 year to get an interest rate. Are you following me? Okay? The waiting price or return that you give me is the interest income. All right? That is why interest rates are charged. Something which you are postponing for future, you cannot do it now, requires a sacrifice, and I should be rewarded for that sacrifice. Like Anna Hazare right now is fasting, and what he is expecting is that he should be rewarded for his sacrifice. Essentially, this is what it is. So, interest rates are essentially that exist in an economy is a reward or a price that one asks for some sacrifice. All right. So, let us start with the concept of the most simple form of interest rate that we learn in not high school, even in secondary school, is say somebody gives a simple loan to somebody. See, a bank gives me a simple loan, all right, which matures in 1 year. So, what happens? There is an interest rate that kind of interest. That is the simplest form of interest rate that you have seen happens or exists in an economy, which we learn in school, class 7 or 8, I do not know when you learn, in secondary school we learn that, all right. Then I will go to more sophisticated concepts of interest rates. Okay. So, a simple interest rate will be, let us take the case of simple loan. Okay. Suppose bank lends me a loan of some amount, say P amount. Okay. Achha. The maturity of the loan is 1 year. That means I have to return the loan period. I have to return the loan to the bank after 1 year, and the interest rate is some I. Okay. Which is say something like 10%. I, that is 10%. Now, what happens? After 1 year, the borrower returns, how much he returns? He returns P plus I times P, the interest rate. So, the amount which is known as amount that I get is P into 1 plus I. That is the simplest form of interest rate that we learn in school. Now, from this formula it's obvious that from this formula, therefore, I can be, even if you do not know I, but you observe market variables data, you have some data on A, if you have data on P, then you can easily construct I, because I will be equal to A minus P divided by P. It simply works out that, all right. Okay. Now, this is not in percentage terms, here I would work out to be 0.1 in decimal terms. Okay. 10% would essentially mean I will be equal to interest rate is say 10%. If I write 10%, then I will be equal to 0.1. That is all you have to write. Okay. Now, this principle, which we call P, principle that somebody lends and then gets back a larger amount A because of the interest rate, this kind of relationship is used in some areas of economics quite prevalently. It is very common. What they do is the following thing. If I put it this way, it may be clear to you. Suppose this money, somebody is having it with him, and P and can go to rave and spend it and enjoy it today. Forget about the bank example now. Forget about the concept of simple loan that I have. Forget about it. You can use this framework to understand something else. Suppose I have 100 rupees with me, P is 100 rupees, which I can spend today. But I decide to postpone my spending by 1 year and put it in the bank and earn an interest rate I. And I decide to spend it tomorrow out of a larger amount. I sacrifice it, I wait out 1 year. Then that P becomes A after 1 year. All right. Is this clear to you? I am coming out of the bank umbrella and talking about an individual having some money. I can either spend it today or I postpone my spending to future, put it in the bank, earn an interest and spend A tomorrow. Tomorrow is 1 year later. Now imagine somebody is investing, either a company or a government, in a project, a river valley project or electricity thermal power plant or something. I am talking about now real economics. Some amount of money today, all right, and then this project will be constructed over a 5-year period, or say simple case 1 year period, and then after 1 year the output of the project will come out as electricity or whatever, which will be sold to the people and earn an income. After 1 year that income will come, my cost is incurred today. So, P is incurred today, a return will come 1 year later. Okay? Now, somebody says, is it worth investing P to get that A tomorrow? Somebody can ask that question. Companies often ask that question, should I invest today to get an income which is an estimated income tomorrow? Okay. So, what they would be interested in knowing when they are investing today is that that estimated income tomorrow, how much is it worth today? Because the costs are today, the estimated return on my investment tomorrow is tomorrow, but how much will it value today? Then I can compare that return in terms of today's values with the today's cost that I have to incur and can tell you whether it is worth it or not. In simple terms, if the costs are less than that return, the present value return or future return, today's value of future return, if the costs are lower, then I would say go ahead. If the costs today are more than what the return I will get tomorrow, even in present value terms, then I say don't go, don't invest. So, here comes a very important concept of economics, which is coming out from this very simple framework, which you think you learn in arithmetic, part of arithmetic in school, but actually is very important to economists. But it is sometimes not that easy to calculate, because I will tell you, if I get into multi-period analysis, I get a polynomial, and in case of a polynomial, the solution is much more complex. One period analysis is easy. So, I am going to tell you how it can get very complicated and no longer medium school, secondary school arithmetic, beyond a point. But the basic concept is very similar to what we find used in economics. So, what I am talking about is that one does get into the idea about present discounted value. Now, the word discount means reduction. अरे अरे चलो वो ये बिग बाजार में बड़ा डिस्काउंट दे रहा है, अरे वो जो शॉपिंग सब है ना, पैंटालून में शर्ट्स के ऊपर, ट्राउजर के ऊपर बहुत बड़ा डिस्काउंट है. What does it mean? Discount means reduction. You are discounting something means reducing it, lowering it. So, present discounted value essentially means something that you will get in future is worth much less today. Present discounted value means presently reduced value of what? What are you talking about? Presently what you are reducing? Which value? The value that you will get after 1 year is worth less than if you have it today. So, when you are saying you are investing in an electricity plant today costs, but the returns will come 5 years later for a series of years maybe, what you are interested in, those values in future, what will be its present value, and that present value is given by the concept of present discounted value. And how is this discount business coming in? Now, I go back to the simple interest formula here. The discount business is coming in. If you look at this formula, a money if I have P today, I spend it is one thing, but since if I postpone its spending tomorrow, I do not need just P, I need more than P. So, the present value can be much less if I have it with me, but for tomorrow if I have to wait, I need more. So, P plus IP, what it would mean? I have a cash P, I go to rave and spend, I get a lot of enjoyment, but my father says, no, you cannot have this money until 1 more year. Now, you would understand what I am saying. Then you would ask your father, take hai, I will wait for 1 year, but I will not be happy with that 10,000 rupees. I need more than that I have to wait out. So, the tomorrow's money, the present discounted value, the value today is much less, means today it is worth more than waiting out for 1 year and spending 1 year later. Then I am expecting much more money to come. So, the difference between A and P essentially, A is coming tomorrow, but the present discounted value of A is P, all right, because then the interest rate is no longer there. So, what you have P according to this formula, what will be the value of P? If A is equal to P into 1 plus I, then P is equal to A divided by 1 plus I. This P is nothing but the present discounted value of A. The simple interest formula I am using to explain this present discounted value. If I have the money today, I have the utility or the benefit and the privilege to use it. If I have to wait out, I need more. So, in this kind of a simple loan concept, what you have is also what is prevalent in economics known as present discounted value of future values, future variables. Then how you discount, you have to discount them if I have to get its number today, and the discount, you say sir discount किधर आ रहा है इधर, ये discount factor है I which is appearing in the denominator. In a fraction anything that appears in the denominator lowers its value. So, you are saying sir present discounted value कैसे हो रहा है, discount factor क्या है, discount factor और कुछ नहीं है, interest rate है. ये इंटरेस्ट रेट आपको बता देंगे एक फ्यूचर अमाउंट का प्रेजेंट डिस्काउंटेड वैल्यू क्या होगा, वेयर यू हैव टू डिस्काउंट इट यूजिंग अ फॉर्मूला लाइक दिस वेयर द डिस्काउंट फैक्टर इज द इंटरेस्ट रेट. इफ इंटरेस्ट रेट इज 0, what is the difference between present discounted value and a future value? Nothing. So, what you see in a simple loan is also telling you that interest rate that you think is a very simple thing, a simple interest rate like this, not a compound interest rate, here you have a simple interest rate, is a very important thing even in the context of more complex economic issues like a person investing in a plant, in a factory, मेरा कंपनी में आज कुछ रुपया, उसका रिटर्न फ्यूचर में आएगा, तो हमको कैसे पता चलेगा इन्वेस्ट करूँ कि नहीं? आप फ्यूचर रिटर्न को एस्टिमेट करिए, उसका एक प्रेजेंट डिस्काउंटेड वैल्यू ले आइए, वेयर यू रिक्वायर अ नोशन ऑफ इंटरेस्ट रेट which is the discount factor, and then compare the two numbers. So, there this I is essentially the discount factor, one can say, sir, take in the context of a simple interest rate, you are trying to explain a discount factor and you are saying that interest rate is also a discount factor in a different context. The context has changed, the formulas are same. ये इसका कोई फर्क नहीं है. But one can also say, sir, there can be better discount factors than interest rate. Of course, there can be. In fact, that what many areas of economics do. They try to look for the best discount factor. When I am trying to find out the present value of something which will happen in future, I scratch my head whole night, entire night, and night after night maybe, to find out the most appropriate discount factor. Once I have it, then the formula is something like this. Formula does not change, except that I interest rate is now replaced by more sophisticated variable. But in a very simple context, interest rate is often the discount factor, particularly in the money market, because money, when you are dealing with, interest rate is often a very lovely variable to use, very simple variable to use. Okay? Now, you tell me one thing, if you are at all with this, present discounted value in a simple loan is okay, but now you will see how complicated it will get, which is my next job, if you have a multi-period loan, simple loan, but a multi-period loan. What will happen? You can refer to Mishkin's book. I have 2 copies, very expensive book in the library. If you want, I can Xerox the chapters. Mishkin has these discussions very well done. He is an American author, monetary economist, very well known. Mishkin's book I bought for you people, so you can use that. Multi-period loan में क्या होगा? Suppose I talk about that the loan matures at the end of 2 period. Multi-period loan, say 2 periods. So, the loan matures at the end of 2 period. What will happen? Suppose 100 rupees, P is 100 rupees, the principal you give, all right. At the end of each period, suppose an interest payment is made. End of each period, the interest payment is made. So, after 2 periods, when interest payments are made at the end of each period, interest payments are made at the end of each period, what will be the amount A? First, you will get back after 2 period, you will get back the principal, then you will get back the interest after 1 period, which is I times 100, plus you will get again after the second period an interest payment I times 100. So, what you will have is 100 plus 2 I 100. So, this formula would be 100 into 1 plus 2 I. This is the amount you will get after 2 period. Now, imagine a case where imagine a situation where interest payments are made only after 2 periods. So, no interest payment will be made in between. I take the loan today, I make no interest payments, finally return the amount to the bank, say. So, the amount will be to first 100, I will get the principal plus I times 100, the interest payment that I am supposed to make after one period, ठीक है, but I don't make that interest payment, I make it after second period. So, after second period what I have is I times bracket the entire principal plus the interest that I have not paid. So, I paid an interest on that, a compound interest is coming. So, I times 100. I have not made the interest payment, I times 100, 10 रुपया मैं दिया नहीं if I is 0.1. So, उसके ऊपर तो इंटरेस्ट देना पड़ेगा, वो भी तो पड़ा है, मैं दिया नहीं, compound interest is coming. In case of a compound interest, what will happen? Therefore, it will become 100 into 1 plus I, and either में plus, if you take out, if you take that, it will be I into 1 plus I 100. This is what you have, all right. Okay. 100 into 1 plus I, and then I into 1 plus I 100. So, what is this going to be? So, 100 plus, so it will be, it will be 100 into 1 plus I square. Okay, this is what you have. Yeah, 1 plus I you factor out, 100 plus and 1 plus I gone out, 100 plus I 100. So, 1 plus I and 1 plus I square. Two different results will follow depending upon the arrangement the bank has with the borrower. Either you make an interest payment after every period, or you make an interest payment only at the end when you return the principal. This is the formula which we usually see often used in books. This is the formula which is not used in the books, except there will be a different change. So, this too is a very important factor. For an n period loan, multi-period can be n period. For an n period loan, it will be 100 into 1 plus n I, whereas here it will be A will be equal to 100 into 1 plus I to the power n. Two different things, two very different formulations are coming out with n there. Yes, you want to ask me something? No. Okay. So, now the question is, you can see from these formulas, these hundreds that stay outside, depending upon the formulation you are using, the present discounted value one case will be A over 1 plus 2 I, 100 is equal to A over 1 plus 2 I. In another case, it will be this 100 is say P, present discounted value 1 plus I square. So, the PDV value, if I am correct, can be of two types. One is PDV is equal to A over 1 plus 2 I. In another case, it will be equal to A over 1 plus I square for a 2 period loan. So, I get a return after 5 years. If I can calculate the return, this 5 years will essentially take that power factor or whatever to the power 5, and I get the present discounted value. I am using a mechanistic thing maybe, but this will help you to understand how the future is discounted if you are sitting today and trying to find out how much is it worth. And the factors that questions that usually come from students is that which are very natural, which you have not asked so far. Sir, one more thing is that what will happen to that inflation thing, because 5 years later the inflation reduces the money value. So, won't inflation also be a discount factor, because inflation is reducing that value. And what I give them as a smart answer, like a smart card maybe, which is not that useful after all, smart answer what I give them is this I is a nominal interest rate. So, it accounts for the inflation rate. You are discounting already with the inflation. The Irving-Fisher rule, what did Irving-Fisher say in the early 1920s? That nominal interest rate is equal to real interest rate plus inflation rate. That American economist said. That is where we learned what the relationship between real interest rate and nominal interest rate. So, what Irving-Fisher said is very simple, is that a nominal interest rate I is equal to the real interest rate R, which we use in ISLM model, plus inflation rate phi, which is inflation rate. And in a futuristic context, this I will become an expected I, because pi will be expected pi. What inflation do you expect? This is how you can calculate. Now, this interest rate that we use in banks, when banks charge an interest rate or something, is not real interest rate, is always the I. Banks always charge you I. R, you have to deduct yourself, sit with a calculator or use your mind to calculate R. R is never reported to the public. What is reported to the public, like when you go to the bank and take a loan or when you put money in a fixed deposit, the interest rate that they give you is always the I, or any interest rate that will come up in future in our discussion will be I. Remember, no R is given. R you can deduct yourself, that is your job as an economist. What is the real rate? So, today fixed deposit rates are how much? 7-8%. Inflation rate is how much? About 7%. So, real interest rate kitna hai? Nearing 0. This is your job. Yes, and real rate will change, nominal rate also changes, bank changes interest rate. Suppose you fix I, yes, all right, you fix I, they are both बदमाश है बैंक लोग, I fix कर देते हैं, ठीक है, and if inflation rate increases, what happens to the real rate? If I is fixed, no, nothing to be surprised. This is often happening in economics. Real rate negative भी हो जाता है. I है 7%, inflation कल 10% हो गया, R का वैल्यू क्या होगा? That is another very fascinating area of economics. That is also a very fascinating area of economics. What is the real rate? How is it moving in India? Macroeconomics I am talking about. Fantastic stuff.